Hey, Bill Lethman here for Money Evolution. In this video, I'm going to be helping you to determine what tax rate you should be using for your retirement plan projection. So if you're working on your plans for retirement, maybe you're even just doing it using a simple spreadsheet and you're trying to figure out if you're on the right track for retirement or trying to figure out how much your retirement is going to cost, one of the big elements of that, of course, is the amount of taxes that you're going to have to pay in retirement, because taxes are one of those expenses that never really goes away. It's going to be with you for the rest of your life. And as you go into retirement, your tax situation oftentimes gets more complicated because there's a lot more moving pieces. You've got Social Security that can only be taxed up to 85%, and retirement plan withdrawals, and maybe interest income or dividend income from parts of your portfolio. And really, again, because it's probably going to be one of your biggest expenses that you're going to have in retirement, figuring out what that tax rate to use is really one of the most important things to figure out. So this is part of a series that I do called E-Money Mondays. E-Money is the financial planning software that we use for our financial planning that we do for clients one-on-one. It's the Money Evolution plan. That's our high-end financial planning program, and also our Retirement Time Machine, which is our educational-based DIY retirement planning program. So real quick, if you want to learn about either one of those things, we'll put some links down in the description below. So let's jump right in. So one of the things, and I'm going to share my screen here real quick, and one of the things that you want to figure out is, again, what that tax rate is. But there's two very important tax rates that you need to know about. One of those is called your marginal tax bracket. And this is where I think a lot of people sometimes get this wrong, because your marginal tax bracket is what most people refer to as that's my tax rate, because that's the rate that you pay taxes on at the highest level of income. But what many people may not realize is that you also have something called the effective tax rate, because not all of your income is going to be taxed at that marginal rate. Some of your income, even if you're making over $1 million a year, is taxed at those lower tax brackets. So here we have one of our worksheets, or one of our reference materials for the Retirement Time Machine, and we can see right here, we can see what that marginal tax bracket looks like. This is for 2025. So even if you do have, let's say, $1 million of total income, some of that income would be taxed at 10%. Some of it will be taxed at 12%, some at 22%, then 24%, and 32%. So let's use an example here, hypothetically. Let's say that you're targeting $200,000 of income in retirement. So we can look at this and say, okay, based on the 2025 tax table, that's going to put you kind of at the upper end of that 22% tax bracket. So if you made another dollar, it's going to be taxed at 22%. If you go over $206,700, then you're going to be in the 24% tax bracket, but only by the amount that exceeds that. So we created something that I think can help to really determine the actual amount of tax, because if you use 24% or even that 22%, depending on where you fall, you're probably going to be overestimating the amount of taxes that you're projected to pay in retirement. So let's say you have that $200,000 of income. You're going to be in that 22% tax bracket, but really you're only going to be at about a 15% marginal tax bracket. In fact, 14.9% would be the upper end of that 22% bracket. The table on the right basically shows what the tax tables might look like when the Tax Cuts and Jobs Act rates expire at the end of 2025. We hope there's going to be some new legislation that might come out that might extend the Tax Cuts and Jobs Act, or maybe do something that's going to keep those tax rates relatively low compared to what they would have been if they were to revert back using the old tax table from 2017. So we put both of those graphs in here just so you can see what that looks like here. So anyway, it's going to be that effective tax rate that you're going to want to use, and then you're going to also want to include your state taxes as well. So we're here in the state of Michigan. Michigan has a 4.25% state tax rate. So if you were using that 14.9, I'd round that up to 15%, and then 4.25% on top of that. So I would probably just say your taxes, if you were in that 22-ish% tax bracket, would be about 20% per year. But here up on the screen, I have our financial planning software where we can get into this in a lot more detail here. And so one of our reports that we have available in the eMoney financial planning program is we have this tax report that shows what that marginal tax bracket is every year as it relates to the various types of income that you're going to have. Now this is our Steve and Sandy Bishop hypothetical plan here, or example plan, and they're still working. They're in their early or mid 50s, I guess, and planning to retire in a few years. So we can see what that tax bracket looks like right now compared to what it might look like in the early part of retirement. And we can see that once they retire, that rate goes down to like 10 or 15% depending on the year. We can also see that visually here too when we look at the tax over time, and we see this big period in the middle here. That's something I've referred to in many other videos as the low tax year. And that's where you might have opportunities to do things like Roth conversions. It's a big part of our planning process and looking at how we can create the best optimized tax strategy for the long term. And it's also going to be something that's going to be very important as it relates to your retirement income plan as well, because you can see that that tax bracket is actually changing a little bit over time. We also have some really great in-depth reporting as we get into some of the specific tax years, and we can see again those are those low tax years here. We can see what their tax rates look like while they're working, and then what it looks like throughout retirement. But here is where we can see what that effective tax rate is. And the effective tax rate, the best way to describe that again is it's the blended rate across all of those different levels of taxation that you're going to have, and depending on what's going on in that year with Social Security, with withdrawals from retirement plans or what have you, that's going to give us that idea. And we can see that in retirement, their real tax rate that they should be using looks like it should be about 17%. Again, through some proper planning and maybe doing some Roth conversions, we may decide to fill up some of those low tax years with maybe Roth conversions, and that might bring down some of the lower the later years with lower taxes later on as things like required minimum distributions and things like that kick in there. This is also something as we get into tax planning, something very important, because we can see, especially if you're still working and contributing to retirement plans like 401ks or Roth IRA accounts, we can see should you be doing the traditional account, should you be taking that money off of your marginal tax bracket, or should you be doing a Roth conversion instead and paying the taxes now so you don't have to pay later. And that's going to come down to what is my tax bracket today versus what is the tax bracket in the future. One thing I'll mention here real quickly, I'm going to make an entirely new video on this, but one of the mistakes I think people sometimes make with Roth conversions is they make the mistake of doing a Roth conversion because they're taking that off the top level of income, only to find out that their effective tax rate later is going to be lower, and they really should have just taken the tax deduction, put that money in on a pre-tax basis instead of doing the Roth conversion or contributing to the Roth account instead. So that's just a real quick basics on what this looks like as we look at marginal tax bracket versus effective tax rate and what you should be using in your retirement plan calculations. Again, having a piece of software that can calculate these taxes on a year-to-year basis where you can add in different expenses, different incomes that may come in at different points, because in reality, your retirement is not going to just be fixed at a certain amount. It's likely going to have years where sometimes you're going to have more income that's going to be needed to accomplish what you want in retirement to be able to meet those retirement spending needs in some years, and some years it's going to be lower. It depends on if you're taking money out of a non-retirement account where maybe there's not as much of a tax hit as if it were coming out of a traditional retirement account. So lots of moving pieces. Again, if you want to learn more about the financial planning that we do for our clients, we'll put some links down in the description below. You can also head over to moneyevolution.com, learn more about what we do over there. Check out some of our free resources and some of our guides that we have that are available to help you with your retirement planning. So anyway, that's it for this video. I hope you enjoyed it. Go ahead and hit that subscribe button, and I'll look forward to seeing you back in one of our next videos. Thanks.